Ever wondered how Trump 2.0, yes, the Donald himself, could stir up New Zealand's economy and property prices? The popular Mark Lister from Craig's Investment Partners joins us next to explain how rising global tensions could affect you on your path to financial freedom.
Financial freedom faster. Financial freedom faster.
If you're tired of lagging behind, join our crew of property investment pros by hitting subscribe. We serve up the freshest New Zealand property news to keep you one step ahead of the pack. Mark Lister of Craig's Investment Partners is a seasoned analyst delivering strategic investment insights. Mark, Donald Trump, is he good or bad for us in New Zealand?
Yeah, right. Well, geez, uncertainty is the name of the game with Trump 2.0. This will be his last term, so in many ways you could say it's got a less predictable version of Trump. Remember, you're only allowed 2 terms over there, so he's almost got nothing to lose, which is a little bit scary. He's a real estate guy. He's a businessman. He's a deal maker. So it's certainly not all bad. I don't think we should be fearful of a Trump presidency. He wants growth. He's business friendly. He wants to reduce regulation. That is music to the ears of business people and investors in many ways. However, he also uses tariffs and wants to use tariffs as his key negotiating tool. So I think the end game there is that he still wants to create a better deal for America. Yeah. Now, his end goal is not crash the share market, crash the housing market, create a recession. He wants to generate growth and returns, but he uses tariffs as a tool to sort of get the outcome that he wants, which will make it a very bumpy ride. And for us here in NZ, we'll just go along for that ride because we're a teeny tiny nation at the bottom of the world that's dependent on doing business with the rest of the world, and there's only so much we can do. We're going to watch China. That's our biggest trading partner by some margin. So if China and the US butt heads and China's growth slows, then that's something that can sort of find its way down under. The US is actually our second biggest export market these days. So, we're impacted directly as well. Luckily, we're not in the firing line. I'm not sure we're on Trump's radar, but it's really that uncertainty and that nervousness that can, I guess, maybe see businesses and investors sort of freeze and be unwilling to make decisions. That uncertainty can be a real killer because it stops people doing things. So we've just got to work with it. We're 1 or 2 months in, so 46 or 47 months to go. My advice to investors or business people is just, box on and don't be afraid to make decisions. I think when you look back to Trump's first term, it was pretty scary. There was all sorts of uncertainty, lots of ups and downs. It was a pretty bumpy ride. But the US share market rose nearly 60%, 60, during that 4-year period. So I don't think putting your head in the sand and just sort of sitting on the sidelines and watching the world go by for 4 years is the right answer. We've just got to be more dynamic, more nimble.
A reminder, join our savvy community of forward-thinking New Zealand property investors by hitting subscribe. Enjoy daily doses of market brilliance and tips that keep you a step ahead.
The United States is quite energy self-sufficient these days with oil and so forth, which is a big positive for them. We don't have that luxury in terms of our, broader energy system. Our electricity system is largely sort of hydro, kind of 2/3 and a bit of wind, still relying on gas and other sorts of energy sources. That's good and bad. It's very clean and green, but it's a little less reliable. And that's one reason why we do need to, at times, pay higher prices for our electricity. That's part and parcel of trying to do things in a more sustainable, clean, green way. Coal's very cheap if we're up for that, but we're not. But we still are sort of dependent on the rest of the world for things like fuel and oil and so forth. And the positives of the lower Kiwi dollar, great for exporters, great for farmers, great for the dairy price, great for the Fisher and Paykel healthcares of this world, but not so good for consumers and businesses that need to sort of import all of those products. And oil and fuel is sort of a big one. So again, as Kiwis, we're just very dependent because we're still quite isolated down here. It's a great country to be in, but we've certainly got a few vulnerabilities, and that's another one.
Yeah, I mean, if you take Great Barrier Island as an example, everything on the island is more expensive because it has to be sent there on a boat. And New Zealand is a bigger example of that. I've found this slide very interesting about what has happened with US shares, New Zealand property shares, and all the global shares. I found it quite fascinating that US shares over the last 5 years have returned on average 14.5%. And you compare that with New Zealand listed property with a negative 3.1% return. Like, why is New Zealand performing so poorly compared to, say, the US or the rest of the world?
Yeah, really interesting, isn't it? And that's only 5 years. So when we're investing, whether it's shares, whether it's businesses, whether it's property, we should be taking a much longer view than that. But what it does tell us is that the Kiwi economy and New Zealand assets have had a really tough run these last 3 or 4 years. I think that's because we've suffered a recession, and not every other country around the world has. High interest rates have also hit us very hard. They've made our housing market struggle, and it's just been a very subdued environment. So the lesson when you look back over the last 5 years is that you've wanted to be globally invested. You've wanted to have money in the United States and the tech sector and the Magnificent Seven. You wanted to be in Japan, Europe, even the likes of Australia. And here in NZ, whether it's shares, whether it's houses, whether it's commercial property, it's been a much tougher ride. So I think it's an advertisement and a reminder that we've got to spread our money far and wide, whether it's your KiwiSaver or whatever. But hopefully, I think it also does suggest that New Zealand assets are arguably starting to look interesting. Some value has emerged, but they haven't performed nearly as well as others in recent years. And as we do drag ourselves out of recession, as those interest rates come down, hopefully we are in for a brighter next 5 years.
So would put your contrarian hat on, New Zealand shares undervalued at the moment compared to, say, how the rest of the world's valued? And if the US shares recently have had a bit of a run, is it time, if you are looking to put money into play, that New Zealand market has opportunity?
Yeah, I do think the New Zealand market has opportunity, and I wouldn't just limit that to shares. I would extend that to whether it's New Zealand bonds and fixed income, whether it's commercial property as well. They've all underperformed, and they are still quite a way down from the peak a few years back. And you contrast that to, say, the US share market, which was up 25% last year, 25% the year before that, trading near record highs. That's a fantastic market, and I think in a long-term sense, that is probably the best place to be. That is the highest growth market. It's the world's biggest economy. Lots of outstanding companies in that part of the world and further afield. But little old New Zealand could actually be not a bad bet in the next few years, and part of that is the fact that it has been a bit under the radar and it's been an underperformer.
So look, let's Mark talk about commodity prices. Great chart here. It's great for us to talk about how strong the export side of things is for us, but I guess that we're getting hit on the imports. So what's going on? Like we're a price taker globally, but I see still strong demand for a lot of the things that we're exporting.
Yeah. So New Zealand is a small exporting nation that pretty much grows grass and a few other things and sells it to the world. That's what we do. And we are in many ways beholden to what is happening out there. That chart is the ANZ Commodity Price Index. So thanks to Sharon and the team for being kind enough to sort of share that publicly. It comes out every month. It's always worth a look. And I guess there's a couple of things at play. One is that commodities for many of these global products have risen. Dairy is the big one. That's one of the big ones for us. Dairy price up 20% last year. They're up a little bit more this year, the highest level since 2022. Part of it's also the Kiwi dollar. One of the benefits of our weak economy, or silver linings, I suppose, is that our currency has weakened quite a bit, as it should have. That's sort of a natural stabilizer. So those prices you see on the chart are being pushed up by global prices increasing and the Kiwi dollar coming down. So we've sort of had that double whammy, and all of those lines on that chart have rocketed up with the exception of timber. So if you're in timber, you're probably not sort of seeing the benefits.
A reminder, join our revolution of innovative New Zealand property investors by subscribing today. Get access to game-changing strategies and insider scoops that put you ahead of the curve. Let's, Mark, talk about this inflation and how it's the enemy of the long-term investor. If they frame it up, now why is putting money in your bank account as savings such a bad idea?
Yep, right. Well, if you zoom out and you stop worrying about what the currency is doing, what Trump's doing, what inflation's doing, interest rates, all of that, in a short-term perspective, and you zoom right and go, what are my big challenges and what am I actually trying to achieve as an investor? And the main one I would argue is you're trying to maintain your purchasing power and your wealth. Like, money's useless unless you can't use it to buy the stuff you want to buy. So you've got to maintain its purchasing power. And inflation is always there in the background trying to stop you from doing that. Even at really low levels, even at sort of 3%, 4%, which is quite low in the context of history, especially for people that will remember the 70s and the 80s. Your money is 3% less valuable and it has 3% less buying power each and every year because of inflation. So it's always sort of eroding it. And what that means is you need to be growing your wealth or your capital by at least that. Just by that level is that you're just sort of keeping your head above water. You need to grow your money by at least that every year to maintain that purchasing power. And that's why cash sitting in the bank, it's fantastic from a low volatility perspective, but the returns just aren't often enough to actually beat inflation, especially when you sort of take off tax. Remember, you get taxed on all of that sort of term deposit income. So as a long-term strategy, cash is terrible. You don't want your money in money. And that forces us as investors to put our money into assets that will grow in excess of inflation. Might be residential property, might be commercial property, might be farms, might be businesses, might be shares, might be all of the above. And I don't care what you do, but, you've got to do something. And the price you will pay you'll get better returns from all of those things, and you will beat inflation. The price you will pay for that is much more volatility along the way. But that is something you've just got to make peace with, because, you look out 10 years, 20 years, certainly 30 years, inflation's the enemy and you've got to beat it. And that's probably the eternal dilemma, or the priority number one from an investment perspective.
Well, thanks for joining us today, Mark. I did enjoy having a look at the presentation, the insights that you've brought in, and I've definitely subscribed to follow along with the what you guys are releasing. You got anything coming up, any events that you want to promote, or is it just for your exclusive clients?
Oh, we've always got events coming up, and they are for clients, but we do sort of always welcome new potential clients. So, my advice would be subscribe to my podcast, which is called On Point. You can find that on Apple, you can find that on Spotify, you can find that on YouTube, or you just follow Craig's Investment Partners on LinkedIn, Facebook, wherever you're looking. The marketing team do a great job of sort of making sure everyone knows what we're up to, and we're actually pretty generous in giving away quite a lot of information for free these days. So there's a world of opportunity out there, and happy to sort of help and educate as best we can.
Well, thanks, Mark. Talk again soon.
All right, thanks for having me.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue. So don't just wait, take control. Mortgage HQ will make you bold. Financial freedom's in your hands. Take that step, it's time.